Hey, in today's video, we're going to look at required minimum distributions, RMDs, and how they affect your taxable income. We're going to look at an example of what someone's income will look like in retirement. And is it a steady income the whole way through, or is it really high in some places? You don't want to miss this, so stick around. My name is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're helping federal employees plan for a better retirement. And so if you've got questions about how required minimum distributions may affect your taxes, you'll want to stick around. So if we go over, let's look at a tax bracket. So this is tax brackets for 2025. And a lot of times we see people when they are working, they're in the upper 22. This is married, filing jointly. So whether there's like two spouses working, maybe even get up into the 24, maybe one spouse is working, but you've, moved up, you're a GS 15, something like that. This is where you are working. When you retire, think about it. Let's say you got a $35,000 pension, Social Security, spouse's Social Security, TSP distribution. You're living on $100,000 of income in retirement. Guess what? You're in the 22% bracket, just like you were before. You're just lower down the bracket, but you're still the same bracket. So the idea that, I'm just going to drop a ton when I retire, not so. Most people, well, let me make compliance happy. Not most people, some people, maybe you will be in a similar bracket. So you're not dropping a bunch. And so that makes, Roth maybe more attractive. So let's look at some RMD planning. If you look here, this is somebody's plan. We removed the names, but this was somebody we talked to. On the left side, it's like income amount, like yearly income. Going across the bottom there is the years. And so you can see from 2027 up until, let's say, 2044, income is on the lower end of things. Like you're pretty low. Now these diagonal lines, going up and to the right, those are the different tax brackets. So you've got 12% and 22 and 24, 32. That top green line there, you can see is 37%. That's the tippy top tax bracket. And you can see there are going to be 3 years that we're showing this person is going to be above that. But if you're just looking, you can see, man, those left years, my income's pretty low. Those right years, my income is jacked up high. What's the difference? And if you'll see there, it's the green bars. The green bars are actually your required minimum distributions. A required minimum distribution is when you have traditional accounts, like traditional TSP, traditional IRA. Hopefully they're growing. You get to be either 73 or 75 for most people. You got to start taking distributions out. I guess the rule was either 72, 73, 75. I think most people we're talking to now, it's going to be 73 or 75. You have to start taking out a distribution. The distribution is a certain percentage based on your age and based on the dollar amount that you have. And so as it keeps getting bigger and bigger and bigger, those green bars there, required minimum distributions, are a lot. And so that's the only change. It jacks them up. The other change on here, you'll see the dark blue lines. Like you didn't have dark blue lines on the left side. You do on the right side. That's the taxable income on the taxable account that we talked about. Either CDs, you got to pay capital gains on a stock portfolio kind of thing, but you got to pay interest on CDs. Where did all that money come from? Why is it not there before? Well, in a lot of people's cases that we talk to, they have enough money. And so they're not really using the RMD to live on. Like their living expenses are being paid. And so you have to take a really large RMD, you're not spending it, you're being taxed on it. Then you go put it in a taxable account because that's all you can do. And then year after year, you start building up a really large taxable account. And so those blue bars are the taxes owed on that taxable account. So then you kind of get double whammied of, I'm getting a huge RMD that's taxable and I'm getting taxed on my other stuff. That's terrible. We got a call in recently from somebody, I think he was 73 years old. He was getting ready to have his first RMD. He was reading off how his tax return is going to look. And he said, like, my RMD is going to be $200,000, which tells me he's got a really big RMD, really big a traditional IRA or TSP. You know, $3.5 million. But he got to take out $200,000 as taxable. That would be the green bar. But then he said, last year I got a 1099 from my bank. I had $119,000 worth of dividends and interest. He had bought a income fund, you know, like a growth and income fund. So it was paying a lot of dividends. Dividends are taxable when they're in that kind of account. And so he says, am I reading this right? Is my normal income going to be even higher because of the $200,000 RMD? Yes, it will be higher. And it's going to be higher because of this $119,000 of taxable interest? Yes, it is. Well, what am I supposed to do about it? We should have been helping you. We like to say we would rather hold up the sign and say, don't go this way, as opposed to do an ambulance service at the bottom of the cliff. Like, we're trying to tell you, don't do this. This is the cliff. The green picture here on the right, that's the cliff. This person calling in was experiencing it. You know, in this person's case here, we've got, 15 years or so. Let's fix it before we get there. And that's where the RMD planning is. What will the RMD be? Do you want it to be that high? Does it jack your income up? Yes. What can we do about it? Well, let's look at some Roth conversions. Now, as I switch over, keep in mind that top green, kind of teal line up there, neon green, that's the top tax bracket. Okay, so when we do Roth conversions, now look at that top tax bracket. You see how the income is so much lower. Now, I believe this person has $1.5 million in today's dollars. They weren't really touching it, and you see how much it grew. But if you'll look here, you see on the left side, the yellow bars are doing Roth conversions. Let's go ahead and do Roth conversions, filling up the tax bracket in those lower years. Once you do that, and you get everything to traditional, you won't have any more required minimum distributions. So notice on the right side there are no big green bars of all these required minimum distributions. You don't have them. Well, not having them has two big pluses. You don't have to take a really large taxable distribution. That's awesome. And since you don't have to take it, it stays in Roth. And so that's awesome. So that's 2. Let's go 3. The third thing is you're not pulling money out and sticking it in a taxable account that's all the time taxable. It gets to stay in the Roth. So the Roth gets to stay Roth and do all its Rothy stuff. So that, in the long run, that's better. Now, keep in mind, when I say it's better, there is a cost of admission. We are, with the yellow bars on the left side, we are moving traditional money to Roth, and you got to pay taxes. So we are causing taxation sooner, but look over here on the right, $2 million of lifetime savings. Now, let me put a little asterisk and explain that. This person is living until I think they're 94 years old. So assuming you're living till you're 94 years old and the money keeps growing under the parameters that we have, this person is saving a bunch of money. Okay? Will your number be $2 million? Probably not. This is on the higher end of what I've seen. But we see $300,000, $400,000 all the time. Would you rather pay taxes on your $1.5 million now or your $6 or $7 million later? It's just math. And so paying it sooner lowers these things. And so that's a key point. One thing we will talk about, I think, coming up, but let me look at here. Remember, these bar charts are your income. I think we've got a slide coming up. We'll talk about Medicare premiums. But just think about it. Once these RMDs start and your income suddenly skyrockets through all these different tax brackets, Medicare looks at your income to determine how much you got to pay. Would you rather pay these premiums, which you can see will be much higher, or rather pay these premiums? If we can get the Roth conversions done soon enough, like before they're looking at Medicare, age 63 and earlier, it can make a big difference. So getting on this immediately is kind of important, which is why, shameless plug, it's one of the decisions you have to make at retirement. So there's 10 of them, but this is a key one. So if you want to check out the new book, go to christycapital.com/decisions to learn all about the 10 decisions that you have to make at your retirement. If you need individualized help and you want to help with your tax planning, future tax planning, what are your RMDs going to be? You want help with that? Go to christycapital.com. Click Talk to an Advisor. We would love to talk with you. To check out another video all about your retirement planning, click right here. My name is Mel Stubbs. See you on the next video.